Dan Skelly of Morgan Stanley joins us right now. And Dan, I guess your first job is to tell me why they're wrong.
Sure. Good morning, Jonathan. And look, we've heard a lot of sell-side updates in the last couple of weeks, but let's face it, the markets continue to dance to the tactical drumbeat of Mike Wilson. And, he was calling for a tactical rally in October. And just over the last week or so, as a firm, we've become a little bit more cautious, just given we've rallied so hard off of those October lows. So, Jonathan, look, I would say the following. It has been a grueling bear cycle the last 10 months for almost everything, stocks, bonds, et cetera. I think, as you well know, and we've talked about for a long time, the original thesis was about fire and ice, Fed pivot, tightening, and then a growth slowdown. Obviously, phase one has played out. I think phase two, you could argue, is also seeing signals that it's being reflected. Just look at, frankly, the move in the long bond over the last, call it 30 or 40 days or so. We've had like a 15% move long in terms of duration. Look at the slowdown in WTI and oil prices. So you can't deny that a growth slowdown is starting to be reflected in certain asset classes. Just lastly, why are we not going all in aggressive at the moment and becoming incrementally cautious? It's all about earnings. As Lisa Shallot has said, as Mike Wilson has said, we still expect some earnings disappointments come January, February.
Dan, much of this year, though, at times, when you were making these big calls, you were flying solo. Now you've got a lot of company. When I played that sound there from Savita, it's the first time I'd heard that kind of thing. Likewise with Alessio De Longis, the overwhelming consensus is that we get a retest of the low maybe from this year in early next year, and then the Fed has to back off and equities rip. And I'm going to go through a couple of quotes just to share with you just how much company you've got right now. This from Marko Kolanovic at JP Morgan, who said the following. We expect the lows we've seen this year in equity markets will likely be retested in the S&P 500 early next year. We see an ongoing trend of pullback in risk assets. That's Marko. Here's Chris Harvey at Wells Fargo. We believe the S&P will trade as low as 3410 in 23 as rates eventually back up and spreads widen. Ultimately, their year-end call, 4200 on the S&P, but still a retest of the low. Does it make you nervous and more uncomfortable, Dan? And I found myself asking that question of you many times over the last few months as you get more and more company and people start to take the same view, and this becomes overwhelmingly the consensus view going into 23.
Sure. And listen, Jonathan, just because it's becoming increasingly consensus doesn't make it wrong. I think, on the flip side, when we look at downside scenarios, Mike has talked about this 3,000 low potential in January. Now, that would be a dramatic low from here, a downside scenario from here. I think a retest of the June lows or the October lows, call it 3,600, would be reflective of maybe more resilient earnings, maybe earnings disappointments, but not to the magnitude Mike's expecting. And I think the second thing, and you've been talking about it all morning with your guests, is about the economy. Obviously, the economy is slowing, but you could also make a case that there's some labor resilience, that there's some spending resilience, particularly on the high end when you look at the income spectrum. And then lastly, and we've talked about this year, when you look at the traditional blowups in credit, from an industry perspective, it's ironic in that given the mix from goods to services and given this massive move up over the last year in energy prices, the traditional weakest hands in credit, i.e. energy and consumer cyclicals, hotels, airlines, fundamentally, they're actually in some of the best positions from a cash flow perspective. So as long as credit holds up, as long as labor and spending holds up somewhat resiliently, you're just not going to get an enormous economic downside. So we're not saying to be all out either. There are opportunities. Just lastly, very briefly, we've started talking more and more about emerging markets as an idea.